Good morning. Welcome to this session on the financial sector toward greater clarity on how the UN guiding principles apply. I'm not surprised to see that we've got a full house in here, even with other concurrent sessions that are very interesting and important as well. But I think that this attendance this morning reflects both the quality of the panel that has been assembled by the Secretariat, but also the growing interest in the role and responsibilities of the financial and investment sector when it comes to human rights risks and responsibilities in general, and the utility of the guiding principles in particular. And I will in a moment introduce the panelists and myself, but just to spend another moment or two framing the theme before doing so, I think it's reasonable and fair to note that the main drivers for the business and human rights agenda over the last dozen years, even before the UN mandate on business and human rights, were largely those from civil society, international NGOs, local NGOs as well, and the impetus came less from the financial and investment community. Nonetheless, there is a growing interest and focus in this community in recent years, and it has some antecedents going back decades to the role of financial institutions in supporting apartheid in South Africa in the 1970s and 80s. More recently, half a dozen years ago, the movement to divest from Sudan in the wake of the genocide in Darfur. These are among the factors that have highlighted for the financial and investment communities the salience of human rights risk. There's a growing effort on the part of a number of investors, not just confined to so-called traditional responsible investors, to understand the salience, indeed the materiality of human rights risk across portfolios, across asset classes. And I'm very hopeful that our distinguished panel today, followed by questions, comments, engagement with this full audience, will contribute further to the implementation of the guiding principles, with actors from the financial and investment worlds playing their rightful key roles alongside companies, international institutions such as the OECD, governments, and of course NGOs, and most fundamentally civil society, in whose interests we are trying to protect and respect human rights. So with that, I will introduce the panel. I believe that our bios are all included in the conference materials, so I'm just going to mention names and titles. I'm Bennett Freeman, Senior Vice President for Sustainability Research and Policy with Calvert Investments, based in the United States. And I'm going to introduce now in turn, first moving to my left, our three presenters who are going to speak for 7 minutes each, followed by our two discussants who will have 5 minutes each, and then we're going to open it up to all of you. I might take the prerogative of the chair to ask the first question. I'll try to make it a provocative one. So turning to my left, not necessarily ideologically, but spatially, from where I sit, and to my right from where you sit, is my friend who I was on a panel with in this room at this conference exactly a year ago, and even calling him a friend, I still stumble over the pronunciation of his wonderful Dutch name, but it's Roel Nieuwenkamp. How's that? I practiced. Who's with the Dutch government, but also plays a very key role with the OECD and the guidelines for multinational enterprises, and he's been particularly active over the last couple of years in trying to clarify the OECD guidance for financial institutions, for the investment community. He's also played a role relative actually to one of the other concurrent sessions. He was the chair on behalf of the Dutch government of the Voluntary Principles on Security and Human Rights. To my left, further to your right, is Liselotte Arni, who's with UBS, who really represents the view of large institutional asset managers, and look forward to hearing from her about how such an extraordinarily large entity such as UBS is beginning to factor in human rights risk and the guiding principles in particular. And then finally, further to my left, and again with some challenge to my ability to pronounce your name perfectly, Daniel Schydlowsky from Peru. You'll help me later. Who's the Peruvian superintendent of banking, insurance, and private pension fund administrators, and he will offer a view from Peru, from South America, of how his government is working with the financial sector there in that country, which, like many others in the region and around the world, faces a range of human rights issues connected to business, whether agriculture, labor, the extractive sectors, mining in particular. Turning to my right and to your left, we've got Pierre Habbard with the Global Unions Committee on Workers' Capital to get the point of view of an international trade unionist, and my own personal view, for what it's worth, is that we've actually heard inadequately over the last half dozen years from trade unionists as really an absolutely critical constituency in this whole debate over the role of business and human rights, and particularly financial institutions. And I'm really particularly delighted that we'll be hearing from you, Pierre. And then Andreas Missbach from BankTrack, who will offer his view as well, working particularly closely with banks in Europe and around the world. So with that, let me turn to Roel to give the first one of our 7-minute presentations, and then we'll proceed in turn.
Yeah,
thank you.
Thank you very much, Bennett. Well, first of all, a couple of words on why the OECD is working on this, and I think there are two major reasons. The first one is that when we negotiated the OECD guidelines in 2011, we opened up for supply chain responsibility, and we had the state-of-the-art supply chain responsibility, which comes down to, for example, using due diligence in your supply chain to manage your risks of having adverse impacts on human rights, labor, etc. So that's one thing. We didn't have time to finish the question, what does this all mean for the financial sector? So that was a leftover, unfinished business from the negotiation. So we had it on the agenda to clarify that. That's one thing. And the second one is that we included the human rights chapter, which was consistent with the UN guiding principles. So we have now a consistent human rights chapter in the OECD guidelines, which is dealt with on the same basis as the UN, which is quite important because the OECD guidelines is the only binding commitment from 46 governments to implement the most comprehensive CSR standard in the world. And that's also important because it's the only one with the grievance mechanism for unions and NGOs, etc. So it's considered to be a very important hard form of soft law. And integrating human rights in the OECD guidelines means de facto that the national contact points, which are the grievance mechanism to the OECD guidelines, are de facto the grievance mechanism for the UN Guiding Principles on Human Rights in Business. And as you probably know, the NCPs are handling already quite a lot of complaints related to human rights. So it's an important element, and that's also the reason why we work on this together with the UN. I will just give a couple of pointers for this discussion, and I hope you don't get the impression that it's easy and simple. But I will try to answer a couple of frequently asked questions first, and try to answer them as simple as possible. First one is the financial sector covered by the OECD guidelines and the UN Guiding Principles? Yes, it is. The second one is, does this mean that private equity is covered? Yes, it is. Are hedge funds covered? Yes, they are. Pension funds, asset managers, banks, insurance companies, they're all covered by the guidelines. So that's quite clear. The other question is, are minority shareholdings covered by the guidelines and the UN Guiding Principles? Yes, they are. If you have 1,000 of investments, does that mean that it's so complex that you should not do your due diligence? No, of course you shouldn't. It's important to stress that we ask the same things from multinationals with more than 100,000 supply chains. And we ask, for example, on conflict minerals to do due diligence on thousands of supply chains, because the severity of the impact is huge in fueling conflict, for example, in the Great Lakes region. It's also important that we say, and the UN Guiding Principles say that as well, you should prioritize. It's impossible to expect from a bank or a pension fund or even a multinational to do a very heavy due diligence on all these thousands of supply chains or thousands of investments. And the way to prioritize your efforts is basically a risk-based approach. So you have to identify your risks, prioritize, and then act upon them. And the most important element for prioritization is the severity of the impact. But you cannot expect banks or pension funds or supply chain, extensive supply chain to do everything. So it's not a zero tolerance approach. That's also an important message. It's a risk-based approach. So there is sort of tolerance for mistakes. Of course, minimizing mistakes is optimal, but it's not a zero tolerance approach. Another question is, do the UN Guiding Principles and the OECD guidelines make, for example, an asset manager responsible if they are investing in a company breaching human rights? Are they then responsible for the impact itself? No, they are not. The OECD guidelines are very clear about this. It's not supposed to shift responsibility from the primary causing entity of the adverse impact on human rights to another party in the supply chain or to, for example, an investor. So the primary responsibility for the adverse impact lays with the company itself, not with a pension fund or an asset manager or a bank. That's also a quite important element. So that's actually the simple frequently asked questions. Then a lot of very complex issues come to the play. So is it easy? No. Is it complex? It's very complex. Just a couple of elements which are important. And the whole discussion is not about are you responsible to do your due diligence, but the question is what is reasonable to expect from banks, from insurance companies, from private equity, hedge funds, pension funds, etc. And that's where the language in the UN Guiding Principles about being directly linked to the adverse impact is still not really clear. So the OECD and the UN are working on clarifications on what it means. And it's quite important because you have in the UN Guiding Principles, as you know, this so-called supply chain logic, which says that if you don't have leverage, you should try to increase your leverage. And that's an important one. But the other one is that you should not disengage automatically, because that's the easy way out. So the first thing is try to improve the situation. If it doesn't work, then at last resort, disengagement. So the sometimes politically very attractive issue of embargoes and boycotts and disinvestments, it's not the approach the OECD and the UN guiding principles are recommending. But it's still a lot of work, because what do you do if you are in a consortium with 7 other players and you're the only one who wants responsible business conduct included in the contract? What do you do if you have only 0.001% and you're still one of the owners of the company and the company is breaching human rights? What is reasonable to expect from that company? And that's still very, very difficult to answer. And together with the UN, the OECD is working on trying to solve all these questions and all the complexities around them. And I think what is very good is that the sector itself is also working quite hard on this. The Toon Group has been doing a lot of good things in this respect. There's also, of course, the work of the Equator banks. They are doing great work on this. So there's already a lot of work ongoing in this respect, but still a lot of questions remain, because the element of due diligence and the whole logic around it and how to mitigate risks, how to prevent risks, is still something relatively new to the sector, apart from project finance. I think project finance is actually one of the easier ways and well elaborated ways of doing responsible business conduct. But there's a huge area of unknowns in this sector. What I would suggest is everybody reads the Toon Group recommendations, and also important for the more technical questions around this area is the letters the OECD asked from both John Ruggie, the Office of the High Commissioner, and the UN Working Group on Human Rights. I asked them to clarify some elements of the financial sector uncertainties about, for example, the term business relationship, about the term what does directly linked to a business to an adverse impact mean. Right. And there's a whole world of technical issues around that, and they provided clarification, and there's in the OECD also an emerging consensus about that, but it's still ongoing work.
Good. Roel, thank you very much for a perfectly concise delineation of some of the major issues out there, particularly the applicability of the guiding principles to different asset classes, different actors. Let's be sure to come back to you and the questions on the issue you alluded to over minority ownership, given the apparent misunderstanding in Norway, but let's be sure to come back to that. Thank you. On to Liselotte Arni from UBS to get a view from a very large institutional asset manager.
Okay. Thank you, Mr. Chairman. I would call us a bank with a strong asset management arm.
Fine.
And I would like to thank for the invitation, and I'm very proud to represent the Toon Group, a group of banks which are now seven banks. Just to name them, it's Barclays, it's BBVA, it's Credit Suisse, it's ING, it's RBS, it's UBS, and it's UniCredit. This group came together to exchange views on a very early stage, actually, what the UN framework could mean for banks and how we should make our interpretation of the guiding principles. So I encourage, as others already did, for those people who are really interested in the discussion, to read our discussion paper. It is a discussion paper, that's really what it is. Those 7 banks have been working together on the paper. It is now out there in the public domain. The purpose of it was, I would say, twofold. One was to inform ourselves about what the meaning could be and to have a platform to have this discussion. And on the other hand, obviously then also as a foundation also for interaction with other stakeholders. The document has been published on the Business and Human Rights Resource Center homepage. That's where you can get it. We put it in the public domain in early October. You may wonder why we call ourselves, or we are known now as the Thun Group, Thun. Thun is about 2 hours from here with the train. It is a lovely Swiss city, historic city, at the Lake of Thun. So if you have the opportunity, take the train. It's beautiful up there. And maybe I come from the region, so therefore I would like to promote also that it is almost as beautiful as the Lake of Geneva, almost. Right. As I said, it was about sharing views, and what we understood very early in the process was that the guiding principles are a great framework and very welcome from our side. But what we also understood is that it needs a kind of a translation, what it might mean for banks, and we thought it is our job as an industry to take this task on and to take a proactive step and to bring up our views how it could be interpreted, how the interpretation could be. The scope is on banks and on core business lines of banks, which includes retail banking, private banking, corporate banking, investment banking, and asset management. So that is the scope where we looked into the 2 elements which we thought from the guiding principles are, for the starting point, the most important elements, which is you need a policy, that is principle 16, it's very clear, and you need to think about due diligence, human rights due diligence. And so that's what we did. We were thinking about those two elements and then break it down. What would it mean in that particular context? I said it before, it is a discussion paper. It's clearly not a standard. It was never intended to be a standard. And for the banks which have signed the paper, it is not a commitment, and I would like to put that very clearly. It is not a commitment that this is our policy now. It is a framework. It is a discussion paper, and each bank will make its own interpretation in terms of where to focus first and how to implement it. And I would like to now change kind of perspective, because now I will talk from the perspective of UBS. I don't talk about the group as a whole, because I can only talk about UBS. I'm the head of environmental social risk. I'm the person who writes the policy together with senior management, and I also have the burden of implementing it. So therefore, I'm quite well positioned to give you some insight about what the process is. We took the paper for our internal review of our current policy and practices. We are currently in that process. UBS has established its human rights statement in 2006. We developed our processes, due diligence tools based on that commitment, and we're now in the process of reviewing it. What I would like to share with you from that process are a couple of things. It gave me really the opportunity to talk to all the business lines about the UN guiding principles and raise awareness. One observation I would like to share with you is that this is pretty new We have been looking at human rights issues in the organization, but the requirement, which is very clear in the UN principles, that it applies to all business lines, is something which needs to be digested by the industry. Another thing is that the impact on rights holders comes first before the risk of the bank is also something which will take time to digest. This is a shift in focus. This is a shift, I would call it a paradigm shift, not only for the banks. We are kind of further down the supply in the value chain. It is a shift for the whole for whole business. So we are dependent on information on how the impact on the rights holders are. So we can do our due diligence if this information is available for us for our due diligence process. We are no investigators, we are bankers, we are risk managers to do that. So what it needs is, we need the information ready for us to use, included in impact assessments. We need reliable information which is in a format which can be introduced into processes to, I think it was very nicely explained that we have very many business relationships. So we need this kind of information, and I think this is one of the really great challenges, because obviously in those discussions with senior management, it was very, I mean, to me it became quite clear. We agree in principle, but it's easy, or it's easier to put out a statement in the public domain that we care. But we need to be in a position to really make it work on the ground. So there is kind of a missing link which I would like to highlight here.
Thank you. Thank you, Liselotte. Very helpful to highlight the Thun Group of Banks statement and noting that it's not a commitment. Also, the work being undertaken by UBS. I just want to mention before turning to Daniel, a piece of work led by the Institute for Human Rights and Business, released this March of 2013, Investing the Rights Way, a guide to investors on business and human rights, done together with the Interfaith Center for Corporate Responsibility in New York and my firm, Calvert Investments. It's a explanation of the guiding principles, highlighting their utility for investors across asset classes to use the due diligence framework embedded in the guiding principles to assess risk across portfolios, across asset classes. And I'm very hopeful that this report will continue to gain traction as both different categories of investors as well as banks undertake the kinds of processes that UBS has now got underway across its operations. Thank you for that. On to you, Daniel, to hear from Peru.
Thank you very much. It's fortunate that I come last and that I can talk right after UBS, because you've just heard, a worldwide bank which has so many things to do and has such complexity that it's almost overwhelming. So it's easy to say we're going to do it, but it's very hard to deliver on it. And this kind lady has a task of making that happen. Now, the beauty of the contrast is that Peru is a rather small economy with a rather simple banking system. UBS, you'll have to come and join us at some point. UBS isn't there yet. We have, so we don't regulate them. And our role as a regulator is to make sure these things happen in our bank. Now, why do we care? Some of you will know Peru is a major mining center. We have, half our exports or so come out of mining. Then we have a lot of fishing and we have some logging. So we have some areas where things are liable to go wrong. We've done very well over the last 10 years, thank you. As a result, we've had lots of conflicts. You do good mining, you have lots of mining conflicts. So we have lots of citizens that don't like what the mining companies do. And some of them have been extremely successful in stopping the enterprises. We have some very large mining projects that have been stuck and have been there. One that's well known is partially owned by Newmont. It's called Conga, and it's probably, I don't know, $4, $5, $6 billion worth, and it's stuck. It's going absolutely nowhere because there's some folks living there and claim all sorts of things, some of them true, some of them not so true, and they've stopped this investment. It's not the only one. So the question is, what do we do about that? It's probably Peru's largest domestic policy challenge. And of course we have the Prime Minister's office involved, and we've got lots of state offices involved, and there's also politics around this thing. And so where does the bank regulator get involved in this issue? We got involved because when there's a conflict, there are going to be losses. When there are losses, they're generalized. Externalities are the name of the game. Out of Conga, we've had people in our office who are small truckers, small businessmen, small restaurateurs who are not able to pay their bills because there's been a very acute, localized depression in that area of the country. So that the Municipal Credit Association of Piura, who is about 500 kilometers away from Conga, have not been able to collect some of their debts because there's been a problem in Conga. So when a bank cannot collect a debt, it shows up on their balance sheet. Who cares? The regulator cares. So the banking system, the financial system writ large, winds up being a place where these bad debts wind up. They wind up on the balance sheet. They got to be provisioned, they got to be loss provisions, all sorts of things. We would like to have an alternative. Rather than provisioning for these things and writing them off, we'd like to prevent them. So we're in the business of prevention. How do we get to prevention? Well, due diligence, have a system that identifies the problems before they occur, try to mitigate them, try to prevent them, and try to contain them. Now, it turns out that these conflicts are very much like an epidemic. They don't go by contiguousness, geographic contiguousness, they jump from one place to another. And some places get infected and others don't. It's really like catching the flu. Some people in the same room, here we are, all of us, some of us will come out of here, have picked up a bug, and we'll be in bed tomorrow. Others will go along tomorrow, we'll be on an airplane, and nothing will have happened. So we find that in Peru, the regions of the country don't get infected, nothing happens. With the same kind of conflicts, others do catch it. So we're trying to understand what happens. Why do some places have a problem, others don't? So these conflicts generate costs. We're trying to contain the costs. We're trying to use the leverage that we have as regulators to get the banks to think about the problems their customers have, so that the customers are going to be more attuned to being careful as to where they put their feet. Now, sometimes before they invest, sometimes after they invest. There's two stages to this thing. When a junior mining company develops a mining concession and they sell it to a major, they're not only selling the geology, which they always document with great detail, they're selling possibly social conflicts as well. We have some towns that have been fighting for hundreds of years, and when a mining company comes in there, they keep on fighting. Now they happen to fight about something else. It's got nothing to do with the geology. It's got to do with the history. And a major buying that property needs to know what they're buying. We'd like the price of that purchase to reflect the social conflict that's going to occur there. So we're trying to improve markets. Now that's very good microeconomics, good macroeconomics, it's good market economics, right? So we're in the business of improving the market, if you like, right? Now, we understand this is not easy for banks to do. And it's not easy for us to supervise either, because we're new at this also, right? So I've got some colleagues here who are racking their brains how they're going to do it when they next go to visit, not UBS because you're not there, but some other colleagues of yours to find out, what are they doing? So we're really reaching through the banks to the real sector to see how can we change the mindset of business generally, to be more aware of the risks involved in stepping on some people's toes, because that risk costs money. And we're really being very hard-nosed about this. We'd like to prevent the losses. And we believe that the pocketbook will drive people's willingness to take this into account and be a little more cautious where they put their feet. Now, how does the guiding principles impact? Well, they obviously do. The guiding principles are a framework in which you can address these issues and you can try to find a way to be more responsive and to look at broadly the feedback effects. we're building naturally. We're doing two things. One is we're about to put out for formal comment a regulation which essentially incorporates a souped-up version of the Equator Principles that are going to be binding on anybody operating in Peru. Now, of course, many of the large mining projects are not funded in Peru. They're funded somewhere else, right? They're funded by UPS and other distinguished banks here in Zurich or in Geneva or in New York or London, what have you. But it turns out nobody can operate in Peru without using a local bank. Because, it's not useful to have, UBS is not there, give you the money, that's fine, but then you have to have a local correspondent to do it. So we do have leverage. Anybody operating in Peru needs to use a Peruvian bank, and the Peruvian bank has to respond to the regulator. Regulator says, hey, you've got to worry about this. They tell their customers got to worry about this, so we have some leverage. We're trying to use that leverage to make something happen. And we're small enough, country-wise, we think we'll have some impact. We've gotten very good response, because what we're doing really is Equator Principles Plus. Our banks are saying, fine, in fact, please do put it into a formal rule so everybody has the same rules to operate by, no matter whether you're large, medium, or small. So the playing field is level. Everybody has to do the same thing. Of course, proportionality always comes in. You inspect some people a little more than others, depending on where your nose tells you the problem is going to be. But basically, and it operates through due diligence, it operates through checking back, it operates through understanding, it operates through developing a cadre of people who know what the issues are. You have to have sociologists and anthropologists, not only mining engineers who will tell you what the socioeconomic contexts are. You need to have some political scientists. You need to know where something is purely political with a candidate who wants to run for office and who's called you grabbing hold of an environmental issue that may be made up, and you need to know where it's real. So there's a whole bunch of things that go on. Some of these capacities are not in place. It's going to take some time to develop them, and we're patient. Fortunately, I've got another 3 years to go on my appointment, so I'm going to be able to watch this process, and I feel very fortunate that I'm here right now, so I can see this happen. And hopefully, 3 years from now, we'll have something which will actually be functioning fairly well. We've avoided some costs. And this ultimately means that the competitiveness of Peru's economy will be greater. Because we can lower risk, we can make things function better, we can cut losses. That translates to productivity. More productivity means more competitiveness, means we can grow faster. Is it worth a 1% more growth a year, or 0.5%? Or, I don't know, not sure. Nobody's done those calculations. But we know if we're going to grow faster, we're going to grow better, we're going to have a fairer society, and we're going to be respecting human rights more. And the bottom line is we need to be fairer to all of our citizens. Now, that's also politically important. So that will translate into political stability. That will feed back onto a better economy, better growth. So, it's well-rounded. Come back to why the regulators is involved. Because the financial regulator has a point of leverage that nobody else has, which is in collaboration with the banks. I don't see it as through the banks. It's in collaboration with the banks and other people in the financial system. But it's congruent with what sensible people are doing the political side. If we can put together good politics, with good regulation, and so the pocketbook works along with the good intentions. The heart and the pocketbook got to work together. And so this is what the name of the game is. It's an art. We understand that we're going to be learning. There'll be some mistakes. I'm absolutely sure we're going to make some mistakes. But it doesn't matter as long as we make progress. Because the only way, what is a turtle makes progress when they stick their neck out? Isn't that true? We need to make progress, and we're going to make some mistakes. But we're going to move ahead. And so we think that what Peru's doing may be useful for some other countries as well. We're, of course, willing to share our mistakes as well as our success as we go along. Right now, we want some feedback from you kind folks, because we still have time before we publish these things to do it a little better. Thank you.
Thank you, Daniel. Fascinating about how you're using your leverage together with the banks, and thanks also for highlighting the Newmont Conga project. There's probably no more graphic example around the world today of a major project put on hold partly because of human rights risks, more fundamentally because of loss of social license to operate from a local community, that also has direct implications for investors. $6 billion is a significant chunk of change, as we say in American English. That's material for investors. So thanks for highlighting that issue as well. Let's turn now to our discussants, beginning with Pierre Habbard. Thank you.
Thank you, Bennett. So I'm here representing the Committee on Workers' Capital, which is a forum supported, funded by trade unions. And it's a forum where the aim is to engage with pension trustees. As you well know, across the world, trade unions have a responsibility in many cases to appoint trustees, so people who sit on the board of pension funds. Bennett, you said that perhaps in the past the labor movement was not very vocal, but perhaps it's also because we spend a lot of time whispering at the ears of our dear trustees. And that, so I would invite you to go on the website workerscapital.org. You can find guidance notes that we prepare for the trustees. So this is the one on the revised OECD guidelines, which has a checklist of what a trustee can do and the board of a pension fund can do when you have a case, when you have a specific case that has been brought to a national contact points under the OECD guidelines, respecting due principles and the rule of confidentiality. So I'm here to comment. Okay. So I have basically three comments that we'll share. One, perhaps we're asked here to clarify how the guidelines should apply to the financial sector. It may be useful to remember that when you talk about the financial sector, it is important to bear in mind the increasing lengthening complexity of the investment chain. And importantly, to differentiate between asset owners and asset managers. I guess some of you attended the previous session on corporate governance, where the Norwegian national contact point representatives exposed, like Roel, the current discussion, debate, almost theological debate at the OECD on the extent to which the M&E guidelines, the OECD guidelines, should apply to minority shareholders. What is interesting is that those who actually, as of today, are opposed to a true a normal understanding of the application of the guidelines to the financial sector, are mainly from the asset management industry. They are not asset owners. So in specific cases, for example, involving Korean companies, those who wanted to restrict the application of the guidelines were not share owners. They were shareholders. They were holding the shares. In the case of Norway, it's an investment branch of the central bank that was holding the shares on behalf of the Norwegian people. In the case of the Netherlands, the party that was opposed was a asset manager holding the share on behalf of a pension fund. And this distinction is, we believe, is crucial. What would matter from a trading point of view are the views of the ultimate owners, the pension funds, the insurance companies. Asset managers are acting on behalf. They may have a right to, in the conversation, but for us it's not the decisive voice. The other point with this that we need to bear in mind in the lengthening of the investment chain is conflict of interest. When you have a large bank, a financial conglomerate with an investment branch, an asset management branch, and indeed when you at the AGM, the asset management branch may be a bit not too courageous to exercise effectively the rights when another part of the bank has also business deals. So that's, I guess, it's important to frame the discussion in what is acknowledged, the lengthening of the investment chain, difference between asset owners and asset managers. The second point is what is at stakes. In a enhanced understanding, a true understanding of the guiding principles when it's applied to the financial sector, I think we have a great opportunity here to move ahead with regard to the fiduciary responsibilities of both asset managers acting on behalf of asset owners. Concretely, it means that it is an opportunity to make sure that exercising ownership rights is not an option anymore. as of today, when you look at the main initiatives, such as the UN Principles for Responsible Investments, it is still a voluntary commitment. The main change, what it has taken today, with the current guidance on applying the guiding principles, and with that the M&E guideline, the OECD guidelines to the financial sector, is precisely to make sure that exercising your ownership rights is not an option anymore. That says, when you are shareholders, ahead of an annual meeting of shareholders, well, if you are informed of severe risk to breach violations of the guidelines, of the guiding principles, well, you have a duty to pick up the phone and talk to management. At the AGM, you have a duty to exercise your voting rights. So that's this is what it has taken. Moving ahead. Roel mentioned that there still is, and indeed the language that is used in the guiding principles is perhaps not completely adapted to the financial sector. For example, used leverage. I mean, I guess for bankers, leverage is a ratio. So there is indeed some need to translate. I would not necessarily leave this in the hands of the bankers, I mean, with all due respect. I think this is a job for where asset owners should take leadership. So I would simply say, don't use leverage. Simply make sure that exercising responsible, your ownership right in a responsible way is not an option anymore.
Good, thank you. Thank you very much, Pierre.
Thank you very much. I'm here as representative of BankTrack. BankTrack is a network of 40 civil society organizations that are working on private sector banks. My own organization, Bern Declaration, is one of the members of BankTrack. I will discuss and comment on the Thun Group's paper onto the aspects of scope, ambition, guidance, and implementation. And while doing so, I will comment on some aspects of what has been said so far. So the scope of the Thun Group paper, it has been said, is focusing on the principles 16 to 21, the operational principles on due diligence. It leaves out the foundational principles on due diligence, which contains some of the, also contains some quite strong wording, which is a pity. But more important, it also leaves out Principle 22, which discusses remediation, but as part of the corporate responsibility to respect. And even worse, or furthermore, it also leaves out the whole pillar on remedy. While it's clearly the case that a company that is directly responsible for agreements is, of course, best placed to provide access to remedy, the UN guiding principles determine, precisely in that Principle 22, that enterprises that have not caused or contributed to adverse human rights impact may take a role in enabling remediation. And the Thun Group banks should have discussed this issue. We are convinced that banks can play a valuable role in ensuring that agreements mechanism is established by the clients of the banks in the first place. And where the bank's business is directly linked to a project that affects the right of rights holders, and when a bank client is violating the human rights and is unwilling to address the issue of effective remedy, then they should establish their own mechanisms for access to remedy. And it would be interesting to know how the Peruvian regulator sees the role of the banks also in providing remedy. Now turn to the ambition of the Thun Group paper. The paper begins with a series of caveats that seek to play down the banking sector's influence and leverage over clients. So let's go what the UN the guiding principles say about leverage. It's the ability to effect change in the wrongful practices of any entity that causes a harm. And by providing essential financing, banks have a higher leverage than, for example, a buyer in a supply chain. Banks also have the possibility to increase their leverage, for example, by the use of specific covenants outlining non-financial obligations of a client. And now we've heard that the Peruvians dare to use the leverage of the regulator to increase the leverage of the bank, to increase the leverage over the client, so that's clearly a sign that there is leverage. And when banks come to the conclusion that they don't have leverage, they always have the possibility to terminate a client relationship. while we completely agree that using this exit option will not per se improve the situation on the ground, because other financiers might step in, it's important for the bank to know where its red lines are. So, and you could even think of that there is such a thing as systemic leverage. If it's known where the bank's red lines are, if it's known which business won't be financed, then this has an influence on current and future clients. So the issue of exit would have deserved further elaboration by the Thun Group. Now, one aspect of the guidance the Thun Group paper gives, the paper covers all the areas of banking, and in corporate and investment banking, the area where many high-risk transactions occur, the paper proposes a different approach depending on whether funds are used for general corporate purposes or for specific investment or purposes. When providing funds for general corporate purposes, the paper advises that the due diligence process focuses on management systems and structures that demonstrate the company's ability to manage human rights issues, and company processes for identifying and consulting with stakeholders potentially affected by their operations. That means that the bank is basing the due diligence process almost exclusively on information provided by the client itself, such as the description of the different processes in place. Only if the client intends to use the funds for a defined purpose should the potential impacts on the rights of affected right holders be assessed. So the focus on rights holders, which is generally well recognized in the paper, we agree on that, is lost in that specific part on due diligence for general corporate purposes. And as I said, the information on systems and processes are provided by the client itself, and banks don't have the possibility to verify them in depth. So the victims of corporate human rights abuse and NGOs that support them, they usually raise their voice against specific projects rather than commenting on processes and policies of the company involved, with the result that their voices remain unheard in the proposed due diligence process. So banks won't get information on impacts on rights holders from their clients. And this is even more serious as there is plenty of evidence that banks routinely provide general corporate financing to many companies that are involved in serious human rights conflicts. So BankTrack is convinced that a company's performance on the ground in delivering actual projects says much more about the degree of responsibility than just its processes. And therefore, we urge banks to include the views of rights holders and their supporters also in due diligence process when providing funds for general corporate purposes, and to take into account in their due diligence process the on-the-ground performance of clients. I come to an end. Just the most important aspect, implementation. We've heard that, and UBS agree. It's really the thing. It has to be. The discussion paper has to be implemented, and it is build a discussion paper, but that's actually the first discussion that's going on that subject. And we really hope that the fact that the paper was not accompanied by a press release or anything, that this is not a sign that the group or the authors are afraid of their own courage. And despite all the critical points, and there are more of them on the paper that lies on the other side of the room, BankTrack has clearly welcomed the paper as a major step forward, and I can even quote one sentence from the paper to illustrate what's at stake. It's about the development of a risk management model that goes beyond traditional parameters, which identifies and assesses potential adverse impacts on rights holders. That's the paradigm shift Liselotte Arni has mentioned, and that is key. So it's really about implementation now, and the implementation is the chance for individual banks to correct some of the weaknesses of the Thun Group paper, such as that no consultation with civil society has taken place. Individual banks can do that while developing their policies. And lastly, it goes without saying that a meaningful implementation of the UN guiding principle is only possible with a much higher degree of transparency, because only then stakeholders will have the possibility to assess if the guiding principles have taken into account in a meaningful way. Thank you very much.
Thank you. Thank you to Andreas and Pierre for really highlighting the critical role of accountability and transparency, whether it's the Thun Group statement or the guiding principles more generally, the OECD guidelines, and roles of civil society and trade unions in particular is critical here. With that, we're going to turn to the audience, to all of you, for quick questions and comments. I just want to hold up a white iPhone that was given to me, apparently missing in action if somebody wants to claim it. So we're hoping to hear from a good cross-section of you in the room, business, including investors, asset managers, civil society, as well as governments. Yes, sir.
Thank you. Good morning. I was hoping the panelists could delve a little bit into how the Thun Group paper operates in practice. And there's this portion of the paper which states, and I'll just quote it, asset management businesses may be confronted with human rights issues in several ways, one of them establishing and managing funds around a topic that could be viewed critically from a human rights perspective. And so my question is, do you believe that the UN guiding principles flatly prescribe, for example, distressed debt funds that acquire defaulted or distressed debts of sovereign states? And if not, can you suggest a framework for how these transactions ought to be assessed by both the funds and banks that sometimes manage their cash under the guidelines for human rights impact? I mean, for example, should a Thun Group bank hold sweep accounts for funds with distressed debt funds that, for example, have recovery rates of 3 to 20 times their investment, or that are engaged in litigation with particular sovereign states?
Big, complicated question. Let's go for a small, short, simple answer, just given the time constraints. Liselotte, you want to hit that one?
Sure. Okay. Let's put it. Let me approach it from a slightly different angle. I think what the UN guiding principles, one impact on our sector of the UN guiding principles is, or will be, and this is a thesis I put out into the room, is that those guiding principles are actually strengthening the case for ESG integration into mainstream research and investment decision processes. That is a bit, I'm flying very high now for this very detailed question. The reason why I say that is, and I think the chairman has already elaborated on it, is on the investment side, the most focus has been on groups or on investments which are tailored for a client base which is very careful and cares about those issues. The big step forward will be to have those topics, ESG, environmental, social, and governance topics, systematically integrated into, as I said, mainstream research and investment processes. And I think that is really what is going to, what will need to happen, and therefore we need the right information to incorporate it. It has been mentioned twice. We need information which is material for investment decision, and we need to have it in the right format. And the industry is working hard on doing that. Should we invest in certain assets? I think this is a judgment call, which needs to, which lies with the asset manager or with the asset owner. I did like very much the point that the asset owner also have a big stake into this decision-making process, and also give clear guidance to their asset managers what they expect in terms of due diligence.
Thank you.
As far as I've heard businesses so far about this issue, is the sticking point is the fact that to implement the requirements, businesses will have to come to some kind of systematic auditing of their supply chains or investment chain. And that may be the real issue for them in terms of burden, financial burden or operational burden. And I would like to have your opinion about this issue, about possible alternatives. And finally, I would like to add that in this perspective, some MPs in France have proposed a bill for mandatory due diligence for human rights issues for parent companies regarding their subsidies and subcontractors. And this bill proposal that was supported by government officials at the beginning just lose the support from the government because of pressures of businesses that were concerned about possible competition distortion that would come because of this bill. So I just wanted to have your opinion about this important matter, especially after what you said, the representative of the OECD National Contact Point. Thank you.
Well, I think that it's a very good question, and what is really asked of the financial sector, it's not only the investment, it's all your products and services. So it's not only investments or ownership or project finance. It's everything they do, and what we are, I think it's. I'd like to echo what Liselotte just said. It's mainstreaming ESG. Risk management in all of your business lines. That's basically what it is, and it's a risk-based system. And I think in terms of the financial sector, it's a good description of what the UN guiding principles and the OECD guidelines are described. Well, of course, it's not cheap, because people have to do this, and it's not easy, because you have so many things in a multinational bank you have to check. That's why it's also so important to prioritize on the basis of the severity of the impact. Right. And that's of course mitigation of the costs to the company. On due diligence, well, it's not the first time it's included. Well, basically this is soft law, and the OECD has been working on soft law and due diligence for a long time. But for example, in the US, it's already hard law when it comes to conflict minerals. So you probably know that if you're listed in the US, you have to do your due diligence on conflict minerals from the Congo, which is tough, hard law. The same goes for forestry in the EU. So there are many things and many proposals around the world where soft law is turning into hard law. Right. And the question is, of course, for France and for many others, does it really work if there's no level playing field? Well, of course, in the OECD always is in favor of promoting a level playing field in this regard, because if you're the only one doing this, there are so many leakage effects that you don't actually change the situation. And our system is there to improve the situation on the ground. And not about just symbolic politics. But it's clearly a trend. Well, you mentioned also the question about minority shares. Yep. I will say a couple of things about that. It's not so much whether minority shareholdings are covered by the guidelines or the UN guidelines, because there's no reason why they should not be covered by the guidelines. And there's a big difference. Why would a minority share of 49% be excluded from the UN guiding principles? There's no reason why. And then should it be 48 or 3 or 2 or 0.1? There is no reason why it should be included. But the valid and very legitimate question is that there's a big difference if you have 49% and a lot of leverage and a seat on the board, or you have 0.1% in terms of what you are expected to do. And that is also a matter of cost to the financial institution, and that's a very legitimate question. There's a difference between having 49% and index trading, for example, If you're trading an index, you do that just to have no transaction costs. But then sometimes you find one of your companies in the index implied in a human rights breach. What do? It's a very valid question, a very difficult one. Day trading is well, it's maybe a very hypothetical question, but day traders are owner of a company for a very small part for only a couple of seconds. What do? That's where the issue of leverage comes in. And of course, there's still quite a big diversity on what leverage is and how much leverage they have. And it's also a question of, are you willing to do something or are you able to do something?
Right. Good. Thank you. Just
a very quick clarification on what has been said twice. It's not about mainstreaming ESG, environmental social governance. ESG has been around before the guiding principle. It's about mainstreaming human rights due diligence in the processes of banks and investors. Let's not forget that, and that's the tricky issue.
That's critical. Anna Puck.
Hi, thank you. My name is Anna Pot. I work for APG Asset Management from the Netherlands, and we do asset management for pension funds in the Netherlands. My question is about leverage, and I was triggered by the discussion about this because I agree that the financial institutions, and in particular asset managers and pension funds, do have leverage and do play a role in promoting human rights protection. But at the same time, I'm a bit concerned about managing expectations, really, because we all know here in this room that in order to be effective and to do effectively use your leverage, one needs to set priorities. You know, as I said, in our institution we do actively reach out to our investee companies about human rights concerns, but and I agree that the role of the asset owners, in our case the pension funds that we serve, are very active and very ambitious. There's no lack of ambition. They want us to go out and talk to each and every company that we invest in on their behalf. But as I said, to be effective in the longer term, to use our leverage and to engage with our companies, we need to set priorities. So I was wondering if you could, BankTrack and CWC could comment on this aspect about really managing expectations on this on the financial sector by our stakeholders. So a specific question, what would you advise pension funds, financial sector at large, how to better explain to our stakeholders the need to setting the expectations, the need to set priorities, and to sometimes say no to NGOs who want us to go after a company that we invest in?
You know, that's a great question.
Thank you.
Nice, if you could get it very...
Microphone, please, for the speaker.
Okay. Well, I think what we completely agree is that banks have to prioritize and they have to focus on the risks. It's in the guiding principles, it's in the OECD, absolute consensus on that. And well, for banks it's also different because they also have to see their leverage not as asset managers, but as when providing financial services in other areas, they really have to look at the leverage because in some business, in some transactions, they really have a bigger leverage. And they also have to have a look at the risk. So it's both. If it's either a high risk or either a high leverage, then they should do much more. Now, specifically to pension funds and investment, I think the only way of managing expectations is actually to show and to prove that they do care and that you do a lot in certain high-risk areas where you have identified that there's a major problem and maybe you have a slightly higher leverage because you have a higher investment in that company or because you have a long track of interaction with that company, and that you really do something seriously and honestly where you do think that you do have leverage. Then you also can argue that, well, but in that specific respect, because we have such a small shareholding or whatever you do, we're not in a position to engage. But then also, there's always the option of exit. That holds true for very small shareholdings. If there's a big problem with a company and you have only a very small shareholding, then it's just exit.
Good, thank you. Very quickly, and then I want to get to a few other people before our time runs out.
Yeah, trade union trustees would expect, if you can, to screen your portfolio, identify sectors and companies at risk. But importantly, once an event occurs, once there is a violation occur, make sure that the asset manager acting on behalf of its pension funds pick up the phone, talk to managers, CEOs, usually ahead of the AGM. That's you will know well that it helps a lot, and team up with other institutional investors in accessing the agenda of the AGM and asking the board to report on the violation. And in the case of the OECD guidelines in the process, to follow up afterwards what the NCP says and so on. So, but we surely agree, asset managers should not substitute to the responsibility of the invested company, but you could apply in a cost-efficient way due diligence. And importantly, once an event occurs, you can, on behalf of asset owners, contact the company ahead of the AGM and afterwards.
I represent a research group that work on bank compliance to human rights after Raggeds for the last 2 years. We classified more than about 200 cases of violations or alleged violations by banks, depending on
The speaker could please move back from the microphone. Thank you.
Project finance and so on. One question. I would like really to know which is the value that the people more perhaps expert than me attached to the word of due diligence. Because due diligence is, in our research, due diligence is at the beginning of a certain operation, but human rights violation can materialize much later. So is the bank involvement in supervision of human rights violation being an endless process? And the second is the problem of leverage. Everybody mentioned this name, leverage. And once more, I have problems to understand what leverage is, because leverage is something that says that when I am strong enough to put condition on the behavior of somebody else, I am obliged to do it. Thank you.
Okay. Quickly to Roel and Liselotte, if you want to comment quickly as well, and then we have a few other people to get to. Please.
Maybe quick words on due diligence. Well, I know that there's an understanding in the financial sector which is more classical on due diligence, but due diligence, as the UN and the OECD understand it, it's an ongoing process. So it's not just before you invest or before you do product finance that you do your due diligence and then just forget it. It's an ongoing process, so you also need feedback from events that happen or alleged breaches of the guidelines, and so it's a continuous process.
Good.
Okay, before I answer the question, I did something very rude. I forgot to mention one very important party in the development of the Thun Group paper, which is the University of Zurich, the Competence Center, and we have Professor Christine Kaufmann in the room. So therefore, my apologies in the first place, because it's. I just wanted to have that information in the floor. Monitoring of human rights performance. I echo what has been said. You do due diligence when you onboard a client, when you do an investment, and you do due diligence throughout the relationship. You have regular review processes in place. Human rights performance is part of that. I can talk now about UBS. So this is an ongoing process, but it's true in certain relationship. We just have. We are just part of the party for a limited period of time, which is kind of in and out, and then there. Obviously, we have not. We cannot guarantee that it will play out the way how it has been presented to us when we made the decision. There is sometimes a time lag. Yes.
Thank you. You're too modest to say it, but I would offer, not speaking on your behalf, that one of the definitions of leverage is if you're a company and UBS asks you about human rights risk. That's leverage. Yes, ma'am.
Thank you. Lisa Stewart from the Royal Bank of Scotland, so one of the other Toon banks, and many thanks to Liselotte for representing us all so well today. We've talked a lot about implementation, and Liselotte said that she can only speak for UBS, but actually she pretty much spoke for the situation at RBS as well when she talked about the implementation challenge and opportunities and the paradigm shift in conversations. So the Toon paper does provide a useful and has been providing a useful internal platform for me and my colleagues in sustainability and risk to have the right conversations with colleagues. Another element I wanted to point out for us and Barclays, who are unfortunately not here, obviously being the UK banks involved in the Toon process, we're also now in the situation where we have a UK national action plan on business and human rights, and that as well has been absolutely instrumental in the paradigm shift with the internal conversations that I've been having. So thank you to the UK government for a very concise and useful document that's been a big driver for that paradigm shift in the conversations that we're having. We also have a long way to go with the implementation, and our key focus now that essentially we talk a lot about the human rights journey. I see our own journey at RBS as coming to the end of the understanding phase, which was really what the Toon work was all about, even though it continues to be an ongoing discussion. And now it's really about operationalising that and rolling out training throughout the business, which is a huge challenge, as has been recognised. And just to pick up on Andreas' contributions, thank you for BankTrack's contributions and thoughts on the paper. We are gathering contributions from a range of stakeholders, and there have been several different organisations and individuals who have contributed written comments on the paper, and we are taking all of those into account. I won't take up time by replying to all of your comments, but on the point that you raised about due diligence and taking stakeholder views into account, within the Toon paper, and forgive me, I'm quoting as well, it does say that banks may review external stakeholder perceptions for all lending, and that's not just project specific. And certainly, to speak again for my own bank, we do take much more than just companies' own public disclosures. We do look at a range of issues when we're looking at any corporate lending due diligence, including stakeholder and NGO views. Thank you.
Okay, we've just got a couple of 5 minutes left.
Microphone, please.
You want to offer a quick comment, Daniel? Let me come back to you in a minute after getting to a couple more people in the audience. Lady at the far back there, you've had your hand up for a while.
My question is actually following up on Andreas' question to Daniel specifically. I know in the case of Peru, the emblematic case of Choripampa, for example, was the unmet grievances of the village. And so I think the larger question of how are you able to actually influence the availability, the adequate remedies to grievances for these communities as a part of your overall strategy?
Just a reminder, interpretation will cease at 1:45.
The grievance issues have to be dealt with at a different level. In the case of the Conga grievances, that goes to the Prime Minister's office, who has an ombudsman for those kind of things. Now, we need to operate at a different level. We cannot deal through the bank regulators with unspecific grievances. What we can do is we can try to have more responsiveness at the company level in response to what the banks are doing with their customers. So, this is a system. You have to think of it systemically, which also ties into the free rider issue that's been raised by several people. If only some jurisdictions do it or some people adhere to it, then there's going to be a free rider problem. But as this generalizes, the free rider problem gets less and less. In the case of Peru, there are not going to be any free riders. There'll be free riders in our neighboring countries, but not inside Peru. We're not going to have any free riders. But worldwide, this is going to be a process, I suppose. 10 years from now, we'll have very few free riders. Right now, we have a lot. So we have to think of it systemically. Number two, I think we need to be aware this is reinforced self-interest. And this ties into the cost of regulation. The gentleman over here talked about the cost of regulation in France, and what about policing supply chains? Of course it's costly, but we have to look at the benefits as well. You know, if everybody does it and we save costs and we don't have conflicts and we don't have the trampling of human rights, those are benefits. The benefits are presumably going to be much larger than the costs. We know from these mining conflicts, the costs are enormous, in the billions of dollars. Anybody who's ever tried to cost these out systematically through a company, a large mining company, found these are very, very large. In the hundreds of millions, sometimes of billions of dollars. The costs to prevention are very small. Having ombudsmen, having experts who know something, that's in hundred thousands, maybe a few $1 million. The other thing is very big. No question, the benefit-cost ratio is highly positive to do this. Absolutely no question. But you have to make sure you don't have too many free riders. Independent information. Yes, of course. Banks have to be able to reach outside. There has to be a cadre of people who are independent experts one can bring in. Is somebody's customer doing it right? We don't know. The regulator doesn't know. The bank doesn't know either. But you have to have people there who are independent experts who you can call in. Sometimes you call them, sometimes you don't call them. Again, it's a gradual process of learning how to do it better. And as people get to do it and the mind chip changes, you need less and less outside experts. On the other hand, companies cannot be expected, real side companies and banks cannot be expected to be experts in everything. They have to be able to call in experts from outside. That lowers costs. When you have a market providing the information that you can buy, it'd be much less expensive than sending out somebody and training them. Go look at Conga, go look at that lagoon, see if it's really polluted. That's very expensive. But if you have the information, you pick up the phone, you pay somebody a fee, come in for a day, tell you about the lagoon, much cheaper. This is, again, the dynamic. System-wide, after a number of years, costs go down. Economies of scale. We know the cost of information go down as we gather better information. So we need to get started. As this thing rolls forward, it's going to be much more powerful, much more effective, less expensive. Cost of regulation will go down. The regulators will have a better time, because this is costly for us as well. And we're all going to do better. Thank you.
Thank you.
From the beginning.
I'm Hans-Petter Grave from the Norwegian NCP, and just 2 quick points. I'm not going to comment the NBIM case, but I would just like to say that I appreciate the work that's going on clarification of the UN guiding principles and the OECD guidelines, but I want to stress the importance that in the field work must continue. So the NCPs have to deal with issues that come, and also the different institutions have to develop their own policies, and they will have to do that in any event, whether one can reach general clarifications or not, because the due diligence and management must be integrated into the thinking and operations of each and every employee of the financial institutions, and that's an individual process. The other point I'd like to make is that I think we have to look beyond risk management, and I would like to give an example from before the financial crisis. In Norway, there's a prohibition against municipalities taking up loans. This was circumvented by creative thinking from financial institutions, selling products that enabled them to convert secure income streams from power plants, taxation, and so on, into high-risk financial products. Luckily for Norway, the financial crisis struck when it did, because only 10 municipalities were bankrupt. But if the financial crisis had struck in 2 years later, perhaps 200 municipalities, half of the municipalities of Norway would have been bankrupt, with the consequences for economic and social rights of the population. So we have to look beyond risk management, I think.
In this session, this has been a very good one. I want to thank the panelists and the commentators and all of you for coming and contributing. Thank you.